So welcome everyone. This is our first of many Offstream webinars with different partners. And while we are at Offstream really focused on carbon credit certification, lifecycle assessments, and MRV, we, because I think of just the nature of our team and how we've grown, have a lot of really strong partnerships with folks. So I'm Varsha. I'm the CEO and co-founder of Offstream. And prior to founding Offstream, um, I worked at a company called Indigo Ag and with Gabe actually, which is where I learned and kind of cut my teeth in the carbon markets. So I invited him here today as one of our advisors and our partners to talk about a topic that many of our customers ask us a lot about, which is basically what should I do about offtakes? So I'll let Gabe give a quick introduction, and then I'll talk a little bit about how we want to do questions and Q&A, but we want this to be fun and interactive, and of course it's being recorded, so you can share it with folks on your team. Welcome, Gabe. Thanks for being here.
Thanks for having me, Varsha. So my name's Gabe. I have been in the commodity space for over 20 years now, as evidenced by the significant amount of gray in my beard. Originally trading older commodities, so corn, bean, wheat, energy, and some currencies. And then, like Varsha said, we met at Indigo, and one of the things we took on there was carbon markets, and so that was fascinating. New market to me at the time. It's still fascinating, and I think for better or worse, still relatively new. But since leaving Indigo, have continued to be pretty heavily involved in voluntary carbon markets, and done some decent deals along the way. So primarily focused on CDR stuff and a little bit of nature-based as well.
Thanks, Gabe. Yeah, I think just to kind of kick off with sorry, housekeeping. It's easiest if you have like a question that you really want answered to put it in the Q&A, because it'll pop up for me, and if you put it in as one of us says something interesting, I'll actually try to incorporate it, and so you don't have to wait till the end of our time to get your question answered. We'll probably do 40 minutes structured with me leading, and then we'll do more Q&A at the end if folks do feel like they really want to hold their questions, or if we don't cover something that's relevant to like a burning question that you do have. So please use the Q&A for questions. If you just have fun side chatter and you think the team wants to see it, you can pop that in the regular webinar chat. Alrighty. So I have about like 10 or so questions that incorporate some of the topics actually folks submitted when they registered for our webinar, Gabe. But before we go in, I just want to start at the top. Like, how would you define an offtake agreement for carbon removal credits?
Yeah, I think if it's okay, I'm going to go just a step back even from that. And I think one of the reasons there's a lot of questions here is what's been a very slow evolution of carbon from a philanthropic activity to a more commercial activity. So conversations not just happening with your chief marketing or sustainability officers, but really starting to move towards including a CFO in that conversation. And so what's important to note is there's the longer you've been in, I think probably the stranger some of the language might be. What you'll hear me use or try to use today is a lot of more, I'll call it standard commodity language, but I'll try to translate those terms. So offtake agreement is a normal commodity term. And really an offtake agreement is if I'm somebody who's producing something, hopefully somebody wants to take that off of my hands, hence offtake. Generally speaking, when we talk about offtake agreements, we're talking about an agreement to deliver something that probably hasn't been created yet, or produced yet. And I think just to get one other kind of version out of the way is there's something called a spot transaction. And so a spot transaction would just be, in this context, I have an existing set of credits that I'm able to sell right now. So they've gone all the way through the issuance process, and really all that's left is for somebody to buy them. And so that's one version. So those transactions are generally fairly straightforward because there's not a lot of risk management needing to happen, especially if it's done with credits issued on a registry. So offtake agreements, and I would more specifically say forward offtake agreements is generally what people are talking about when we talk about offtake. They fall into two broad buckets. One of them is a pre-purchase agreement. So that's an agreement between a buyer and seller, right? They agree to buy those credits for you from you at some point in the future, um, and they probably don't exist yet. And that's kind of the most frequent version that we see. So it's just an agreement between a buyer seller to take production off of a producer's hand at some point in the future. There's another variation on that, which is specifically a prepaid forward offtake agreement, in which case there's money coming from the buyer ahead of those credits being delivered, and that the structures of those things can vary significantly. Hence our conversation today. But that's really the at least from an agreement perspective, those are the three buckets. So there's a spot transaction for credits that already exist and are moving hands today. There's offtake or forward offtake agreements, which is an agreement to buy credits at some point in the future. And then there's your prepaid forward offtake agreement, in which case I'm receiving, as a producer, I'm receiving some cash today ahead of actually delivering the credits.
Thank you. So yeah, we're focusing on the latter two today, and because, I mean, actually, why do you think that is? Like, why is that the prevalent topic that everyone wants to hear about?
Yeah, well, so I think there's a couple reasons for it. I think as a project developer, it's really helpful to have credits pre-sold. It lets you plan ahead for revenue. It potentially allows for some easier fundraising, right? If you can show that there's demand for the product you've created. Um, and potentially you may be able to borrow against those agreements if you have what's called a bankable agreement, which has to meet some certain criteria, but something you can borrow against. Those are the big reasons. And then obviously a prepaid forward offtake agreement is really attractive because you're getting cash today for a credit you haven't created yet. And again, working with a lot of project developers as I have, getting money today is super helpful for most of us. So that's why it's a hot topic on the production side. But I think it's also important to note that's where most of the buyer activity is as well. There's not a lot of high quality credits available for sale right now. If I wanted to buy a credit that exists out in the open today, those are really difficult to find. So that forces the demand side to also, engage in these forward agreements.
Yeah, I don't know if you've seen the super critical report on offtake actually. They just published it a couple weeks ago, but we can share it as a follow-up. It's great, and I shared it on LinkedIn a couple days ago. It really highlights that um a lot of the high quality carbon credits on the market are already tied up. Or yeah, a lot of that volume is already tied up basically in offtakes because of exactly what you're saying. So thank you. Just thanks for indulging that philosophical question. Okay, I want to come back later to bankable agreements, but I don't want to get too far into that rabbit hole. So if anyone wanted to hear that definition, don't worry, we're going to get there. Before we go into some of the technical things, just high level, I think you have a really clear way that you and I have talked about around like who is participating in an offtake on the buy side and why. So I'm just curious how you think about the different types of companies who are signing offtakes, maybe the companies we don't talk about as much in the news, so less Microsoft and Google, but you can include them in your summary. Yeah.
Sure. So I'll use a really basic segmentation on this, and buyers for me fall into roughly three categories. And so one of them is a thought leader, and so that is your Microsoft, Google's, and people that have joined some of those buyer clubs with them, like Frontier, and that kind of thing. And so they're looking to be seen as a leader in the space, probably also solving for some real problems, but you know, comfortable having earlier stage discussions with a project. The next category I'll say is risk management. And that's going to be, a lot of your energy companies or really heavy emitters, right? So we always, when we were at Indigo, we talked about heavy emitters in two categories. There's groups like UPS where emissions is not something that's part of their company. It's just a large side effect of them operating, versus somebody like a Shell or a Total where emissions is their business. And so, but they both fall into that generally more transaction category. So they're trying to get as many credits as they can at the lowest price possible that satisfies whatever risks that they feel like they're exposed to, whether it's brand or government related. And then the third bucket is philanthropic. So there's still plenty of philanthropic activity in the space, especially with your more frontier technologies or first of a kind technologies. Philanthropic's a great route to go. So those are kind of the three buckets I think of buyers in.
Yeah, thank you. Most of our audience is many of our audience, let's just say, are like biochar or biochar adjacent. So I'm going to ask some specific questions about it, just because hopefully it'll help them answer. So you mentioned kind of those three buckets. Of those three, is there one that you see buying the most biochar, and why?
Yeah, so today I think that thought leader category is probably going to buy the most biochar, and the reason for
Hmm.
that really comes down to price. So the transaction focused groups that I put into that bucket, they really are trying to do as much volume as possible at the lowest price possible. So they'll take the risk on buying a credit that costs a couple bucks. Not that they don't have biochar or high quality CDR in their portfolio, but we can talk more about agreement structures as it relates to that because they'll tend to be a little more constraining in the agreements that they do, at least in my experience,
Hmm.
than the thought leader bucket. So on the thought leader side, what you're looking for people in that category, they're generally trying to solve a risk management problem, but oftentimes it's not acute. So they're not feeling necessarily a lot of direct pressure today, but they're more worried about making sure that they have enough piled up for say 2030, 2035. And those higher quality removals will persist in counting against those targets, whereas something that's in a lower cost avoidance is you know kind of ethereal, right? It's unclear if they'll be recognized at that point in time. Um,
Hmm.
and even so, there's if you're a fan of the carbon year accounting structures, those single year offsets, they cover a year, or avoidance credits cover a year. So the biochar especially, but really the CDR category is expected to persist over time and not really be contentious.
Okay, so maybe an energy company would purchase biochar as part of a portfolio, but they're solving for like a hair on fire emissions target 1 year, and they're okay that it's like basically it's a very different asset to them, is what you're saying.
It's a very different asset to them, and I think they're putting on their trader hat a lot of times when they're doing
Mm,
a high quality CDR credit. And so what they're gonna, I mean, and to be fair, most buyers will want to obviously buy at what they think is the best price they can get, right, highest
hmm.
value. But they'll be the most aggressive in driving price down, because they won't necessarily be looking at a smaller quantity of CDR as their own direct offsets, but more lever that for expected demand coming down in the next couple of years. So resell those offsets to a different buyer.
Nice. Do you have a sense for it, like for companies who are participating in their first offtake or they're newer to the space, are there triggers that get them from not buying to buying?
Well, so if you're working with somebody who hasn't bought offsets before, from a sales perspective, we really think about that as an educational sale. And
Hmm.
so it's tough to say there are individual triggers, but the focus there is if you're in a sales role, you're going to have to spend a lot of time educating not only on your solution but the broader market. You're going to have to help them because they're going to hear things about, oh, I can buy a credit for $2. Why would I pay you $80 or $150 for your removal? And that's like, if you're not equipped for that conversation, working with a first time buyer that really doesn't have a lot of context can be really challenging. Um, and so my focus there would be a lot of exploration on understanding what their needs are, because you need to get to understand, like, are they doing, is the person, the decision maker, have they been tasked with just buying offsets? Because if that's the case, it's going to be harder, I think, to do um, a higher cost or a higher value credit sale to them, just without any other context. But if it's somebody who's seen the work of some of the thought leaders and saying, oh, we need to line up with that, like, we see what they're doing, it kind of makes sense, then I'd spend more time trying to figure out if we're the right fit for them. um, Also, as you're doing that exploration, they're probably going to be smaller quantities. When I say so, you're
Hmm.
probably not talking about thousands or tens of thousands of credits. You're probably talking about hundreds, give or take. And so it's just something else to keep in mind in terms of, based on what your production is and how you want to
Oh,
scale.
that's interesting. I actually hear from some of our customers that buyers don't want to come to the table for fewer than like 10,000 credits. And so that's a big barrier to even like having that conversation. How would you square, well, do you agree with that? And how would you square that with what you just said?
I think for somebody that's established a view in the space, I get that, right? And there's
Okay.
probably there's also they probably don't actually have a credit quantity in mind. They're probably thinking about dollar size of the deal.
Right.
And so that's really the question I want to get to is like, are you saying 10,000 credits because you won't do a deal if it's, under $200,000, or is it, were you expecting to do at least $1 million, right? Like, so understand it's a helpful way to explore what they're anchored to from a price perspective.
Thank you. I couldn't tell if we got a question. So this is something I think some of Offstream's customers actually ask us, and I don't have a perfect answer for, but well, the context is that, well, yeah, before we go into actually quickly, like we often hear from developers and we see in the news like direct transactions, especially for offtakes. So corporate buys directly from a company. It's almost like an equity style transaction. And there's a sentiment I hear a lot that that's better than working with like a middle person. What's your take on that?
Um, I think you're getting some marketing bias in terms of what you're seeing. So the larger,
Hmm.
again, people in that thought leader category are going to lever those purchases and the fact that they've made them, as they should, right, for all the clout that they can in the market. So you're going
Sure.
to hear more about those deals, and they're done direct. And those people generally have teams and support structures that are big enough where they can do direct deals.
Hmm.
Really, where the intermediary comes into play is if you're a small to mid-sized company looking to purchase, it's difficult to have the competency in-house to do that yourself.
Hmm.
And so using a broker or some other type of intermediary can be really helpful for that if you trust that they're capable of doing the diligence. Also, you could still buy direct and hire out, an audit firm that's competent in the space to help out. So the only other thing I'll say is one of the biggest risks in the market, especially for a forward agreement, is headline risk if you're a buyer. And it's such a asymmetrical risk that it's difficult to predict. And there are human biases that basically make us think that if we're the one in the driver's seat, we've got more control over that. And like that's the literal experiment that they do is understanding like what people think their probability of getting an accident if they're driving versus somebody else driving, right?
Oh,
And so
that's
so
funny.
magically they think their stats go down, or get better if they're the one in the driver's seat. But that applies to any number of things where risk is involved, and so
Hmm.
this is no different. So there's probably a bias to if I think like if the complexity doesn't scare me away, I'd probably rather be directly doing transactions. There's also additional fees that you see when you're paying for an intermediary. You know,
Hmm.
so
Yeah. If you were a project developer, like and you're let's say about to launch your first facility is about to be commercially operating, let's say like 3 to 6 months from now.
mhm.
Um, when would you when would you begin the like buyer outreach process and yeah, when would you begin it?
I'm going to ask for clarifying our scenario. So
Sure.
I'm less interested when the facility's going to be operational. If I guess, can we assume that I expect to be issuing credits 3 months from now?
Yeah, or 6 months from now,
Or
let's
6 months.
say.
Okay.
Yeah.
And the reason, I guess, for everybody listening, the reason I'm making that distinction is when you get certified and issue a credit, one of the biggest challenges as a project developer is a lot of that's out of your hands. So you can do everything you can to get all the information and quickly answer questions, but depending which registry you're working with and where you get in line, you may end up with an unexpectedly long wait. And that's really important because you may be doing everything right and still not get a credit within 6 months of when you think you will, or better said, when you should, right? So it would get retroactively issued. So there is a really big distinction between I've already issued one credit or more,
Hmm.
and I haven't issued any. The other thing is, if I've issued a credit on a registry, I've also demonstrated it's a very cut and dry way to say, like, have you done everything the registry requires? Right. So if you're pursuing buyers ahead of actually having issued a credit, literally issued, even a single credit, you're going to have to lean more into that more thought leader space. or where there's an intermediary who's well educated in the space, because they're going to have to do a bunch of diligence on whether or not they think you'll be able to close the gap in the timeline. Yeah, I say that also a lot of it depends on the risk that's in the actual contract itself, right? I as the buyer, if I don't want to do that diligence, I may give my way, and I know we're not talking specific terms yet, but I may give myself outs such that if you haven't issued the credit in 3 months, like I can tear up the contract and, you know,
Hmm.
no harm, no foul.
Yeah, we're almost at the terms part of the, I feel like everyone's waiting for their questions for that. But I guess if so in terms of like milestones I would want to hit before I approach a credit buyer, would you say the ideal scenario, if I can stretch my cash flows, would be that I have issued a credit binary, even if it's not for the project I'm selling for? Like it was my first project and now I'm on my second. Like, but obviously sometimes people need an offtakes to secure the capital you need to get their first project. So if that's the case, their best bet is with the Microsoft Googles or folks with more of that thought leader appetite.
Well, yeah, so I mean, it's a tough question to answer just because so the further away I am from issuing a project or
Hmm.
issuing a credit for my project, the more I'm going to have to lean in that thought leader space. But it's also worth noting that bucket of buyers doesn't move fast.
Yeah.
Some of them can take like Microsoft, I've heard, can take almost 2 years to fully run through their process, right? Even when everything's running well. And so, like, I mean, if you're leaning on that, right, or buyers like that, you're probably not really solving a capital problem. Um,
Mm.
it's worth noting. And so, it, there's no magic bullet here. But so the short answer to your question is yeah. So if the ideally I'd have issued one credit or more from the project I want to do an forward offtake on, that'll be the easiest to do diligence on, because all the work I would have done to issue that credit, that should fill my data room, answer almost any question they're going to have other than general business questions around my solvency as a counterparty in the future. But the next best is, like you said, I have an existing project that I issued credits on that's very similar to my current project. Um, that should satisfy a lot of things and should put you in a position to comfortably and quickly answer diligence questions around that forward purchase agreement from the next project. And then obviously the furthest back is you haven't done that fully at all. And then it's really just a function of, again, being able to answer enough of the questions about where you are today and what path you have, how clear it is that you understand the path you have to walk to issue a credit. Uh, and so some of those counterparties will be more comfortable with earlier stage stuff,
Hmm.
meaning you've got schematics or something like that versus others won't. Um, and but again, you'll see if you're coming to somebody at that point, you'll see different things pop up in an agreement relevant to your stage.
Thank you. I have a tactical question that has to do actually with timing and process, and then I promise we'll get to the terms. So, if you're a buyer sitting and you're having an intro call with a potential project developer that you might participate in offtake in, like what is the dream introduction call? Like what does that developer bring to the conversation? What do they have ready to share with you? What's in that data room? I think the term data room can be a little bit of an enigma to folks.
Yeah. Um, trying to think of what order. So again, relevant to the stage that you're at. When I think about when I have a so when I used to when I was actively pre-purchasing credit. So the deals I did most frequently were prepaid pre-purchase agreements. And the things that we wanted to understand on the first call were what type of project is it? So, if most of the folks here are biochar CDR, like that's a flag you should, be more than happy to waive. Like it's just a nice, clear thing, right? It's a biochar removal credit. Like that's what I want to hear. If you know what registry you're going on, I want to know that. I want to know whether or not you've issued a credit, right? That's a really helpful thing.
Mhm.
Um, I also want to know like what volume and when. So I've had over the years I've probably now talked to somewhere between 150 and 200 project developers, if not more. And like vague responses to that question is like almost an immediate, like, I'm out, right? Because it tells me that there hasn't been a, like, they're not, for me at the point where I was buying, there hadn't been enough thought in terms of what operationally was actually happening. Um, and if you give qualifiers for that volume estimate, be prepared to answer questions about those qualifiers. So if you haven't issued a credit, where exactly are you in the process, right? So like I said, have you picked a registry, or are you not even at that stage yet? If you're not, and so I think most buyers become less and less likely to engage the further back you are in that process. And so we would just keep walking down that path until either we found something that a foundation we could have a conversation off of, or we just get to a point and say, yeah, you guys are probably too early for us. You should know, if it's a call, you should know what price you want to transact at and what price you won't go below. Um, and it's tough to tell on a first call whether or not you're going to even have a price discussion. But things I would do is like test. I might bring up, the Puro published price is a really helpful, non-controversial thing. I might bring that up to gauge like temperature on what they think they're going to pay for credits. If I wasn't really comfortable talking about price yet, or it didn't make sense. I, being a trader for a long time, I would generally come out and be very direct about what price, like, we were looking to get things done at, and go from there. But I'm under the impression that was unusual. But you should still know, because you want to know whether or not that conversation, the next call is worth having.
Okay. Yeah. I'm just struggling because it's kind of classic like sales negotiation tips at some level as well.
Absolutely.
And um, you know, I do sales all the time now, so I think about it a lot. So, okay, so that's the call part. And then have you seen a dream data room? I just want to touch on that a little bit. Or is
Um,
that based on the stage essentially?
well, so if we're talking about just a standard pre-purchase agreement without any prepayment, the dream data room should largely reflect what you've done for the LCA, right? And ultimately get, what the process and the trappings around becoming registered. That should largely satisfy most folks.
Mhm.
Um, Now, if you're dealing with somebody that understands biochar really, really well, they may have more technical questions for you. And so, but by and large, that should get it done, or at least give people enough that they're comfortable where they can come
Mhm.
then ask more specific questions. I think that's totally fair game. The you know frustrating versions I've seen are when there may be, because of the geography you're operating in, there might be really specific policy that I don't know about. And as opposed to pulling out the germane pieces of policy that you need to direct me to, you give me a pile of policy documents, and because you're worried about potentially, I guess, taking on liability because you didn't disclose the right things or something like that. Um, like, if you're dealing with Microsoft, that's probably fine. If you're dealing with a small buyer team, that may end things right there, because
Mhm.
that's probably another set of attorneys that you've got to go hire. Um,
Okay. Yeah, so takeaway there is like a lot of the same documentation you might be sharing with the registry, or I don't know actually if we've talked about this much, but Puro has a formal pre-assessment. Isometric has an informal one now, which essentially the output of that is like a 2-3 page summary that says, based on what we know today, you're on track to being able to issue credits. Like it's better than nothing.
mhm.
That plus kind of anything else around the LCA. Is it important that that LCA is third party, or does it not matter as long as you can understand it?
I mean, well, so if you're registered, right, then it doesn't matter
Right.
anymore. Um,
Okay.
so ahead of that, it doesn't necessarily need to be third party. That may be a
Hmm.
hurdle that a buyer is going to need to get over one way or another, right? So if you don't have any of these things all the way done, that's going to lengthen a diligence process, because either
Hmm.
they've got to pull it, they may need to physically go to your location or pull in other experts to to ask the right questions, to de-risk things. I should call it, the only other thing that I didn't bring up is like some high level business plan is probably helpful for a forward
Yeah.
agreement. Um, Even without pre-purchases, if I'm signing a forward agreement for you, I want to understand that your business model is going to allow you to stay in business for the duration of the agreement.
Mhm.
Um, so obviously don't be, you don't have to, it's not an investor call, right? It's not an investor diligence. So if they're not handing you cash up front, you shouldn't expect that level, but you should be able to articulate your business model and rationalize why you think, you're going to exist however many years from now.
Yeah, thank you. Okay, the fun part. Let's talk terms. Well, your comment on timeline actually mattered to me, or it kind of triggered that in my head. So, what? I mean, take this however you want. I think you and I have talked about this one-on-one as well. Like, what would you say the biggest terms are that come up in a, let's just use pre-purchase, like the standard kind of no cash upfront agreement?
Yeah, so there's a couple different versions of this. And so we used to see, which is to say, up until 3 or 4 years ago, a lot of versions of these agreements didn't have a lot of teeth to them. And this is actually a problem that's existed in the voluntary side of the market for as long as its existence, and been part of the reason it's had so much volatility as kind of a industry. Um, it that largely seems to be going away now, but that'd be my first call out is the agreement real? If you to bring the credits that you've agreed to bring on the day you agreed to bring them, are they required to buy them? Right? Which may sound a little silly, but I've seen plenty of agreements where they weren't, right? Where basically the buyer had the option to purchase those
Hmm.
credits, but not the requirement. Um, I'll just
Yeah, that would be
close it.
right of first refusal, right of first offer, right? Yeah, one of
Yeah.
our attendees asked that question actually, like buyers want that. Um, what would you say? Would you say that's a non-starter for you, or like what would need to be true for that to make sense?
Well, so yeah. So I think it's important to note, oftentimes there will be a base part of the agreement, which is I'm going to sell you whatever 5,000 credits a year for the next 5 years, but up to 5,000 more, you have the right of first
Hmm.
offer on, right? So that kind of agreement, like maybe I'm comfortable with that, right? Like it's been a really friendly conversation and so forth. Especially if it's right of first offer, like great, like you're basically agreeing you're going to be polite to each other on future dealings, right? Like it's pretty inconsequential. If somebody has a ROFR on my credits, that's a right of first refusal. That's a completely different discussion, because now they have, like, I am required to bring them a credit before I sell it to anybody else, and they'll generally those come with a price. Now, it might be the highest price I was able to find outside of them, but the challenge there is I go do a bunch of work to, maybe I did my first sales at $50 a credit. Now I found somebody who's paying 100, and I worked really hard to do that, built up this relationship. Somebody's ready to sign a contract. Now I've got to take it back to my original buyer who paid 50, and they're like, yeah, fine, we'll do it at 100. Now all the work I did to get that new buyer at 100, like they're going to be frustrated, right? Even
Hmm.
even if I am super transparent, like, hey, there's this ROFR, I'm going to have to show it to them, blah blah blah. That can be really frustrating on the buy side as well. It may hurt future negotiations, but you may get something in return from that original buyer that makes it worth giving that up. And again, it totally, like, there's so many moving pieces in any given deal. It's tough to say like, oh, it's worth it if you get this. Uh,
Sure.
but the other thing I'll say is what you don't, or kind of the original version I was talking about, is where the buyer has a right of first offer, but that's it. And so they could walk away. So there's no required offtake. In that case, like, I mean, that agreement, other than sticking in a data room to maybe make a potential investor happy, doesn't have a lot of value to it. It's certainly not bankable. When we talk about bankable, we're talking about a strong enough contract that a bank would look at it as a future asset, that you could borrow money against, and that contract is like leaps and bounds away from that. You couldn't talk somebody into it. Its biggest value is saying, well, I got somebody to put on paper that they would consider buying my credits at this price at that point in the future. which is slightly better than you didn't get it on paper, but 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 it's not
Sure.
particularly strong. So unless that's what you're solving for, that's probably not an interesting agreement. Um, so I would try to get some minimum quantity as a required purchase in there. The other side of that, though, is if they're required to buy it, you're probably required to deliver it. And so as we've moved from this philanthropy heavy version of the industry to more commercial or profit driven, um, that's been a pain point, I think, is because, of course, who of us wants to be obligated to do anything, right? Like the more freedom we could have in the future, the better. But that's kind of the sticking point, is you need to be very confident about your expected production and that you'll be able to meet that delivery. And in fact, when I was negotiating on the buy side, I would absolutely lever that to my advantage in that I wanted you to be that too. So when I would do my diligence on you, I was trying to make sure that I was 80 to 90% confident that you were going to be able to hit well above whatever, we're agreeing to. I would also then put very heavy delivery penalties if you failed to meet that expectation. Um, and I would expect you to agree to that, because
Mhm.
when we've gone through the diligence, going back to specific terms, I'm going to expect you not to sell the credits that I'm owed to somebody else. And if you've been forthright with me about your expected production and volumes, when I was doing a deal, it was such a small amount. It should have been, ideally 25% or less of your expected production. You
Mhm.
shouldn't have concerns about delivery risk with me. If you do, like that's a we'll call it a yellow flag, right? There's something that I'm missing. Now,
Mhm.
as you get to higher quantities, right? Sometimes you'll have folks that want the right to all your production, and that can be a trickier conversation.
Yeah. Yeah, we've talked about defaults a little bit. So, um, in previous chats, you've said often you would spend a lot of time defining what defines a default versus just a delay.
Yeah.
Um, is 3 months a delay? Is 6 months and so um is there a norm around what definitions for those two, or not yet?
I'm not familiar with the norm. I think within a couple months is a reasonable amount of delay time.
Hmm.
Uh, when I think about specifics in contracts, I might want to say, like, it might look different in the middle of the contract than it does at the beginning, if that makes sense. So I may give you a little more leeway for your first credit if you haven't
Hmm.
ever produced credits, because I also need to be reasonable, understanding that the registry could potentially cause delays that neither one of us expects, even though everything's
Right.
running. But if we're in the middle of the contract and suddenly you're not hitting deliveries, like, that's a lot more concerning.
Yeah. I just saw, sorry, Greg and other folks put questions and I just saw your questions. I think it's still relevant actually. So, you know, today, Puro, let's say you're 3 months from being operational, but they often take like 3 to 6 months to get to put that final rubber stamp on there.
Mhm.
Like, would you say if I'm going with Puro and I'm anticipating it might be 9 months from now that I'm actually fully certified, like what should I as a developer do to protect my risk protect my delay risk there in that contract?
Yeah, so you're going to have that conversation up front, right? Like that,
Mm-hmm.
like, first and foremost, I would want to be super transparent about, again, this is the world where I've done everything right. I've got all my paperwork in, and I want to be really clear that we're like, here's my test results off my stack. Like, here's my emissions. Here's all the things. Puro should approve it. And in
Mm-hmm.
fact, if you can get an email from them that says, well, there's that, pre-approval indication, right? You can do all that. And in the contract, like, just have a real conversation about, here's this thing, it's an unknown, there is clear data that shows Puro can take 9 months to do it. I can't handle a penalty, right, if that happens. Now, on the flip side, when Puro does approve you at the outer end of that band, they should be issuing credits
Mm-hmm.
historically for the entire period, right? So it shouldn't, and this goes back to understanding your buyer, like, what problem are they solving? If that buyer needs credits 3 months from now, like, you guys should not be entering into this transaction. Okay, like, and I think you're going to be more valued long term as a partner and a provider of credits if you are super clear about that and actually help them understand that. Because you not only will you not put yourself under a stressful situation, you may help that buyer avoid other situations where somebody doesn't understand all the challenges you can run into in terms of going through the registration process. And then I would turn that conversation into, can we talk about delivery 12 to 24 months out from now? And I understand you're solving a 3-month problem now, but like I'm gonna have credits 12 months from now. Let's talk about that. That
Nice.
that's what I do.
Yeah,
So,
and when you say setting that, oh, go ahead.
well, I was gonna say, I do know there's some buyers that, like I said, are aiming for like a 2030. They're accruing credits, thinking about the end of the decade, so they're not going to care, right? They will a little bit from a indicative ability to hit things, but if they're thinking that rigorously about markets, they should understand the Puro issuance challenge. And it's not just Puro, right? It's all these registries.
Right, yeah, all the
No, I
registries.
don't want to pick on them.
Exactly. Awesome. And then really quickly, I just wanted to get Brewer's question in, which is around timing a little bit. But let's say you have a preliminary LCA and you have some, like, it sounds like contracts with teeth for both biomass in and biochar out offtake, but
Mhm.
there's no registry certification work done yet. Is that a non-starter? Like, would you say you got to go figure out the registry before you move forward, or can you move forward with a carbon credit offtake conversation?
I mean, if what we're talking about is carbon credits, yeah, I don't want to, and I'm very much talking about me, right? As somebody who's done these, like, you're too early stage for me because I don't. There are so many little things about going through the process that
Mhm.
even if you've got high quality biochar coming out and high quality biomass puts coming in, there could be something about your process that just really hamstrings your ability to generate a carbon credit, and so I don't want to get tied up in that.
Yeah, makes sense. You're transacting credits. You want to see some progress on those credits.
Yeah.
Um,
Well, I will say, if you now that being said, if you've got all the economics sorted out, X carbon credits, that's a really interesting conversation for anybody who's an investor in the space. Because if you've got the economics working without the carbon credit piece, that's awesome. And like that I would go knock on every investor door with. So just to be clear about that, because and then the carbon credits become gravy on top.
yes, I mean, I think we are seeing this delicate balance of like diversifying revenue, but still proving additionality. And we talk about that a lot with our customers. Like, I think in the charitable philanthropic world of carbon credits, it was like the only credits were the only revenue stream for a lot of projects. Like for most of our customers, it's not developed, like no one wants them to be, but making sure that the credit is still additional. It ends up being something you just have to navigate delicately. But I don't want to digress too much because we have some interesting questions um, on getting back to the terms. So you were talking about default triggers and not wanting to sign like a right of first refusal. We have an attendee who asked a question around actually exclusivity. So in most conversations, they say with large credit purchasers and middle intermediaries, they bring up exclusivity on the buy side. Um, they ask
I'm
kind of
laughing.
ominously, is this the start of the monopolization of the carbon credit industry? But like what do you think on exclusivity? And is this something that you think is going to persist, or is it just coming up in certain conversations right now?
Most buyers would be foolish not to try to pursue exclusivity with any high quality project. Like, full stop. They should be asking that as a matter of course. Okay. So like, if somebody's asking for that, that's a compliment as a starting point. Um, Principally, I have a really strong aversion to it. Um, I mean, and it's it's a concern. Like I said, I got my start in commodities. I'll talk about cattle for a second. So I work for Cargill, which is this massive, right, commodity player, and talking to ranchers, they would intentionally sell to, they generally have a plant that they were delivering cattle into, but they'd intentionally sell to one or more other plants even if it wasn't as profitable, because they were trying to make sure that their primary plant would never solely have access to their supply and that they had those routes open. And that's a far more mature industry, obviously, in the US. And I think, that was smart. I think that flexibility and it takes intent to preserve it. And it's going to cost you in the short term, but I think in the long term pays out quite well. So if I reframe the question and say, would I ever take an exclusivity agreement? Absolutely. It all depends upon what are you paying me, right? Like, and is it exclusivity forever? Is it exclusivity for the first 3 years? Is there consideration for the appreciation of price? Like, are we using, the Puro index or something else to agree on what I'm going to get paid? Um, are you guaranteeing to purchase all the credits I create? Because that sounds kind of awesome on project one, right? If somebody's guaranteeing that they're going to buy every credit and it's at a price that makes that project work, great. Because now I'm a successful project developer and I can go do the next one, and jump off that. There are scenarios where I think it makes sense, but in the abstract, like, I'm really hesitant to allow somebody exclusivity. I mean, one of the things is probably right to talk about is equity. So some of these things come up more in deals where there's pre-purchasing involved, where the buyer has more leverage, as they should, because they're taking on more risk. And so the question is, what are you going to give up to that buyer because they're taking on more risk? And so equity board seats are things, different versions of equity, which might be warrants, it might be options. They shows up in lots of different ways. The thing you want to be wary of there is ultimately control, and make sure that control is sitting, in a place that you like. And you may feel like, oh, I'm going to make up an arbitrary story here. I've given up 20% of the company to this, buyer. And so they don't have majority. But if I have other investors, right, and that buyer is a significant player in the space, I
Mhm.
could find myself, if together I own less than half the company, I have effectively given up control. No matter how well I get along with my investors today, things could happen where that buyer that owns a hefty chunk may want to make a play for driving how the company's run. And so it's difficult to envision on the day you sign the deal, but it does happen.
Sure. Are you familiar with the structure some folks take where they set up an SPV for each specific project site?
Mhm.
Can you just talk a little bit about that?
I mean, so setting up I guess just so we're all clear, an SPV is a special purpose vehicle.
Oh, yeah.
Uh, and it's a tool used to basically create a wholly independent company for a specific purpose. And so you may have a project sit as its own legal entity, and that
Mhm.
lets you do some of these, I think, more aggressive financing opportunities, right? Like, so giving up equity in that specific project, or giving exclusivity to that specific project in a way that doesn't tie up your overall operations. Um, it has some conveniences from an investor perspective. So especially around the equity piece, um,
Mhm.
I guess anybody with half a clue that's looking for exclusivity is going to go beyond the SPV, right? Or they're going to ask for equity in the parent or
Okay,
other
that's
ways,
helpful.
right?
Yeah,
So I would really, an SPV isn't really going to defend against that in and of itself. It really is a tool for if somebody has specific criteria they need to invest or deploy capital in some way, it lets you do that.
interesting. Thank you. I want to define bankable agreement for folks just so we can leave them with that. And then I do have one more question on specific terms, but if anyone else has other like burning questions on terms, pop them in and we can always send a little write-up after if we can't get to all of them. So yeah, what does a bankable agreement include?
Yeah. So again, a bankable agreement is an agreement that a bank will be comfortable lending money against, right? So you can go to, and we say bank is a broad term for somebody who's a lender. And it's basically looked at as an asset. The reason you would be able to look at it as an asset is because it has a price and total deal value. So if I agree to sell 10 credits at $5 a credit to Varsha a year from now, right? Um, and Varsha signs it, and that agreement is enforceable. And so bankable means if Varsha fails to pay me the $50, I have one or more paths to get that $50 from a legal structure perspective, right? So maybe I can sue her, or I don't know what else I would do, but I have, or I can see some of Varsha's assets. Um, they, there's lots of ways you can get compensation, but effectively the bank looks at it and goes, okay, this is an asset. Like this agreement to deliver credits is an asset worth $50. Now the bank's not going to lend you $50 against that agreement, no matter how good it is. They might lend you $20 or $30
Mhm.
and probably charge you more than you'd like for that. But it's a way to get financing where the bank's not going to take equity, right? It's a more traditional structure. That being said, it's also hard to find banks that are comfortable looking at a carbon agreement and lending against it. You're probably going to end up talking to somebody that is a heavy operator in the commodity space because it happens in commodity markets all the time. If I'm producing oil, right,
Mhm.
and have a forward agreement to sell oil, it's, those agreements are very mature and well tested in courts, and so they're almost always considered bankable, right, barring something unexpected in their structure. And
Who is an
so
example of some of those commodity groups that folks could approach with a CDR or a biochar offtake?
you'd have to be big.
Okay.
Macquarie is a great example. Um, Cargill has a group that's capable of it. I don't think they do any of it, but I know Macquarie's been active in the space previously. They're probably the biggest, well known. I'm trying to think of traditional banks that might do it. Um, Depending on where you are, I would actually look at local banks or regional banks, especially if you're in an area that has a lot of agriculture, uh, because ag you're basically doing those same types of agreements. Farmers borrow money against grain contracts all the time. Sometimes they'll borrow it from who they're delivering it to, but they can also go to the bank, and the bank understands those contracts. Um, but like, I don't think unless you're talking about hundreds of millions of dollars, you're not going to get J.P. Morgan to take a look at you.
Yeah. Yet, hopefully many of
Yeah,
our,
yeah.
yes.
Well, I don't think J.P. Morgan is going to take a look under $100 million for most things.
Yeah, exactly. Awesome. You actually talked a little bit about risk, and so the last question we have on a specific term is around indemnification and limitation of liability provisions.
Is that a lawyer
Maybe if
asking that question?
I don't know, Tim, if you have any follow-ups, definitely feel free to put them in the chat. I'm guessing you're seeing people maybe are have abnormal or not atypical clauses that they're asking for, Tim. Have you seen that, Gabe, or what would you expect? What's the status quo?
I mean, the indemnification is, I mean, that when I've seen people disagree on indemnification, it's largely been more out of lack of communication around what they meant, and so it just
Hmm.
takes language clarification. Limitation of liability has definitely been far more involved as a discussion. As a project developer, like I said, you're trying to find everything you can to limit your liability in the case where you're not able to deliver. Um, and so obviously you can generally get acts of God. That's pretty straightforward. But if we're dealing with biochar, you might want to put something in there that says, well, if the price of the feedstock goes up 3x, I don't want to be obligated because my economics don't work anymore. I'm like, I will tell you as a buyer, I don't care. Like I'm not interested in your feedstock problem. And that it's the way it is. So you might get on that thought leader side, right, some more leniency. But at the same time, if I give that up to you as a buyer, there's something I'm going to want to take instead. Because now I've just taken on risk in a market that I don't understand at all in terms of whatever the feedstock is going into your biochar. I expect you to understand your feedstock situation. Um,
Yeah.
but that, and so you see that in most CDR is there's some sort of piece of one or more pieces of the formula
Mhm.
that are variable cost. and the developers want to protect against unusual price movements in there, which, while reasonable from a developer perspective, generally the buyer's not going to care. Like they're not going to be interested in letting you out of that. So,
Thank you.
mhm.
Okay, kind of like a parting thought, perhaps. So obviously there's a lot of terms that can be negotiated in an offtake, but to get favorable terms, developers need to find leverage somehow. Like if you were to guide our audience, like what would you do to give yourself the best negotiating power and leverage in an offtake discussion?
I'm trying to think what would cause me to pay the most money. Um, so, I mean, one of the favorite deals that I did was with BC Biocarbon. So biochar out of British Columbia. Um, and I liked them for a number of reasons. Now, remember, we were doing pre-purchases on those, but the things that were attractive to me were, one, they had a really solid handle on their economics, and forget Phil's last name, but I mean, he'd spent like 10 years developing the technology ultimately that they used to run their process, but with a strong focus on cost and scale. And so I was excited by here was somebody who understood their process really, really well. The economics made sense. We took a look at it, and he'd been running a pilot facility for a couple of years at that point. Um, and so like all those things for me, well, and they had multiple revenue streams because they were doing biochar. They're selling, I think, the wood vinegars and um, I forget what else out of that process. But um, so that was an attractive deal because they'd done it already, because they had multiple revenue streams,
Mhm.
um, and they knew what they were doing.
Yeah, maybe they knew what they were doing piece is like they deeply understood the business side of it. And so, especially for you in that seat, you said you were prepaying cash. It had more of that like equity investment type feel, like investment type
Yeah.
deal feeling versus a transaction deal. So, yeah, I know. I think it's tough, right? When you're a capital holder versus as someone seeking capital, you're constantly trying to put yourself in a position to get the best outcome for your company, but there is just inherent asymmetry in the market with anyone that has dollars and people who want those dollars. And so that was an underlying theme in a lot of the questions we got, and something I think folks each kind of find what their edge is going to be.
Yeah, I mean, said another way, I think the more succinctly you can answer questions as you go through the diligence process, the more confidence you'll convey. And so always what extended things, even if we ended up doing a deal, was when we got fuzzy answers to questions. Um, even if it was a not not the answer we wanted, I'm way more likely to continue to engage if I felt like you knew the answer and just told me versus it felt like something I had to uncover.
Right. Yeah.
Um, but that's also totally reliant on the type of buyer you're dealing with.
Yeah. It's almost as if yeah, it's like, what's the Gabe persona?
Yeah.
But yeah. Awesome. Well, I really, really appreciate you doing this. I hope folks enjoyed it. We will share the recording. And just a couple other resources that Gabe has shared with me in the past that I think would be helpful is actually the Frontier CDR Offtake example, which they publish on their website. It has just a lot of detail. So if folks have never seen an offtake agreement, I would just review it. It's not perfectly standard, but it does kind of show you what that looks like. And it's a pre-purchase, not a prepay. So it fits into that norm. And then we have and then if you're interested in more, there's other resources from Supercritical, like I mentioned in many marketplace companies actually on offtake that will send us a follow-up. But thank you all for joining. And we will also ask for your feedback. So please give it to us because we want to continue to do these and want to know what you want to hear. Yeah.
All right. Thanks, Varsha.
Bye,
Thanks,
everyone.
everybody.